The world changed overnight. On a quiet Thursday, reports flooded in Israel had launched a large-scale surprise airstrike deep into Iranian territory, targeting nuclear enrichment facilities, long-range missile bases, and key military installations. The images were shocking, fiery explosions lighting up the desert sky, smoke trails rising over heavily guarded compounds. But as the missiles hit their targets thousands of miles away, another battlefield erupted silently and swiftly. Wall Street. The financial markets reacted almost instantly. Oil prices skyrocketed. Brent crude surged over 10% in a matter of hours, climbing past $74.00 a barrel. U.S. West Texas Intermediate wasn't far behind, jumping over 7%, closing near $73.00. For perspective, that's one of the biggest one-day spikes since the pandemic. The reason? Fear of supply chain disruption, fear of escalation, fear that the Strait of Hormuz, the lifeline of 20% of global oil supply, could be shut down by Iranian retaliation. The mere possibility of that choke point becoming a war zone sent shockwaves through global markets. On Wall Street, the response was brutal. The Dow Jones tanked over 760 points, shedding nearly 2% of its value in a day. The S&P 500 dropped more than 1%, and the tech-heavy Nasdaq slid even further. For investors, this wasn't just geopolitical tension, it was a direct economic threat. Oil prices affect everything: transportation, manufacturing, shipping, agriculture, and especially inflation. Higher fuel costs ripple through the economy like poison through a bloodstream. The fear gauge, officially known as the VIX, spiked nearly 17%, a clear signal that investors were scrambling for safety. Gold prices rose sharply, treasury yields fell as traders rushed into government bonds, and energy stocks exploded upward. Oil giants like ExxonMobil and Chevron gained ground fast, while airlines, delivery services, and travel stocks plummeted. Tech companies, already sensitive to macroeconomic swings, faced a double blow: rising operational costs and growing uncertainty over the Federal Reserve's next move. For everyday investors, the headlines meant more than just stock tickers. It meant retirement portfolios shrinking, 401k taking a hit, and savings losing value faster than anticipated. But the panic wasn't just retail, it was institutional. Hedge funds dumped high-risk assets, foreign investors started pulling money from U.S. equities, and for a moment even crypto surged as people looked for a hedge against traditional market volatility. Then came the second wave: retaliation. Iran responded with a barrage of drone and missile attacks targeting Israeli positions and U.S. bases in the region. Though most were intercepted, the message was clear: this wasn't over. As warships moved into position and international airlines rerouted flights away from Middle Eastern airspace, the markets braced for the unknown. Oil hovered above $70.00, and financial analysts warned that if the fighting intensified, prices could breach $100.00 in weeks. Historically, markets tend to recover quickly from geopolitical events unless they disrupt oil. That's the wild card. During the Gulf War, oil spikes triggered global recessions. During the Russia-Ukraine conflict, the initial impact was heavy, but markets bounced back. This time, the threat is more volatile. Iran isn't just an oil producer, it's strategically positioned to strangle global energy flows. A single missile hitting a tanker in the Persian Gulf could send prices into orbit and bring inflation roaring back. And that's where the Federal Reserve enters the story. Just weeks ago, investors were betting on rate cuts by late summer. Now, not so fast. With oil surging and inflation creeping up again, the Fed might have to stay aggressive. That means borrowing costs stay high, mortgages remain expensive, credit card rates keep climbing, and businesses pull back on hiring and investment. In other words, economic drag at a time when recovery was already fragile. Meanwhile, behind the scenes, a more shadowy game is unfolding. Defense contractors are booming. Lockheed Martin, Raytheon, Northrop Grumman all saw significant stock increases. But what raised eyebrows was the timing. Days before the strike, unusually large options trades flowed into defense stocks. Whispers of insider knowledge began circulating in trading circles. Was it luck, or was someone tipped off? For those watching the financial undercurrents, this wasn't just war. It was opportunity disguised as tragedy. Governments around the world started reacting too. OPEC members held emergency calls. The US began pulling reserves from the Strategic Petroleum Reserve to try and calm markets. China, heavily reliant on Iranian oil, issued veiled threats, while Russia positioned itself to take diplomatic advantage. This wasn't just a regional war, it was turning into a global economic chess match, and every move carried a price tag. At the same time, major multinational companies began adjusting forecasts. Airlines slashed growth projections. Shipping companies warned of delays and detours. Semiconductor manufacturers in Taiwan started preparing for supply chain disruptions. Even agricultural giants like Cargill and Archer Daniels Midland voiced concerns, fearing grain and food prices could soar if shipping routes were compromised. Inflation wasn't just a line on a report anymore. It was back in people's grocery carts, gas stations, and monthly budgets. Back in the US, Main Street was already feeling the pressure. Gas prices at the pump jumped 20 to 30 cents overnight in some areas. Airline ticket prices spiked as routes lengthened and fuel costs rose. Businesses began talking layoffs again. Consumers, already stretched by years of inflation and rate hikes, pulled back on spending. And just like that, a conflict halfway around the world was tightening wallets in American households. So where does this go from here? If peace talks begin, markets might stabilize, but confidence will take longer to return. If the war widens, drawing in regional powers, disrupting more oil, or triggering cyber attacks, then all bets are off. The next few weeks could determine not only the fate of the Middle East, but the trajectory of the global economy. One thing is certain: Wall Street is watching every missile, every troop movement, and every diplomatic word with laser focus. Because in this new world, wars aren't just fought on the battlefield. They're fought in the markets, in central banks, and in the wallets of everyday people. This isn't just a geopolitical crisis. It's a financial time bomb, and it's still ticking. If you're following the money behind the missiles and want more breakdowns of how global conflicts rewrite financial history, subscribe now. Because the real cost of war isn't always paid in lives. Sometimes, it's paid in dollars, and we're all footing the bill.